What's up, everybody? Austin here. All right, today we are talking about dividend kings. It is rare that these things are undervalued and offer a great opportunity because they're just so stable. When everything's out, everyone's out there all in these risky stocks and everything. These dividend kings have paid a dividend. They've raised their dividend for 50 or more consecutive years. That's what a dividend king is. And it's a rare opportunity that we get to buy them at discounts. All right. And so today I'm going to talk to you about my favorite dividend king. I own it in my portfolio. I'll show you just in a second, but let me just show you the growth streak of some of these dividend kings, right? We've got 68 years with American States Water, 68 years for Northwest Natural, 67 for Dover. And then you've got all kinds of companies. Parker Hannifin is another company that I like. I don't own it, but I like it. 3M, believe it or not, has raised its dividend for 64 straight years. I don't know if they'll be able to keep that up with everything going on. But the company I'm talking about today that I own in my portfolio is Lowe's, okay? And quick thing here, it says it may be undervalued. This is simply safe dividend. A way you can kind of check that out is the dividend yield is 14% above its 5-year average. And so when the dividend yield goes up, that means the stock price is down. That's why the dividend yield being higher could mean the stock is undervalued. It's also trading at a PE ratio of 14.6, which is below its 5-year average. And in a market today where the S&P 500 is trading around 17 or 18, I like that discount to the S&P 500. Dividend safety rating of 93 from Simply Safe Dividends. Okay, these aren't 100%. That doesn't mean 100% certain the dividend's not going to get cut, but they take into a lot of factors like payout ratio, free cash flow payout ratio, debt levels. And for Lowe's to have a 93 safety rating in today's environment is a really great thing for its dividend. And what I really like about it is its 31% dividend growth in May of 2022. Over the last 5 years, Simply Safe Dividend is reporting a 20% 5-year dividend growth rate. 62 years dividend growth streak, 62 years of uninterrupted dividend. They pay quarterly. And then, we're getting into that low payout ratio of 29%. So I do it a little different here. This is my channel. I'm sharing my portfolio. I am building this portfolio up to $1 million over time. That's my goal. And I'm showing you my position in Lowe's. So I have a $9,165 position. It's up $853, so about 7%. And I've got 45.29 shares at an average share price of $191 per share. So a nice little gain so far, but would like to own this company for a lot longer. All right. This is Fast Graphs. It's one of my favorite tools for analyzing stocks, and it's just a very quick way to see this blue line right here, which is the normal PE ratio over the last 20 years or whatever time frame is showing on this graph. We could see that its normal PE ratio over that time is 19. This orange line represents a PE ratio of 15. And you can see really the only time it's traded down to a PE of 15 is leading into the financial crisis, the Great Financial Crisis, during the Great Financial Crisis when everything got crushed, and then a couple times here and there since then, and most notably recently, back in COVID, and then at basically the market lows in 2022. Well, now, a lot of stocks are up, but this thing is right back down to a PE of 14.84. And so this is pretty cool because it shows these are just analyst expectations, right? 1% earnings per share growth. This is the earnings per share that analysts are expecting in 2024, 25, and 26. These can certainly come down. They've grown their earnings at 13.47% per year over the last 20 years. And so, I think they're going to very likely be able to continue growing their earnings forward. Even if we hit a recession, they'll get over it. So with these pretty conservative earnings expectations, even if it just trades at a PE of 15 for the next until 2026, you're looking at a total annualized return of 24% for 8% per year. That's pretty darn good. And that does not include any dividends. So if you include the dividends, you're going to get even more. And right now it pays about a 2% dividend yield. So you'd add about 2% per year on top of that. If it trades up to its average PE of the last 20 or so years, which I don't think it will, but this is the high side. It goes up to about a PE of 19 for a 17.6% annualized return. Add the 2% annual dividend, you're at about almost 20% annualized return in a very safe stock through 2026. Okay, another one you might consider is Home Depot. I mean, another great company. Before we jump to Home Depot, let's actually show the historical performance of Lowe's. If you own the stock since 2003, you would have received a $10,000 investment in 2023, would have paid you $15,600 in dividends since then. So your investment has been paid back and then some just in dividends. Total growth has been 159,000 when you include the dividends for about 15% per year. And its dividend growth has been very strong, 26% on average over the last 20 years. Jumping over to Home Depot. Home Depot is another one that looks undervalued. I just don't think it's quite as undervalued as Lowe's, trading at a blended PE of 18 versus about 14 for Lowe's. And you can see it's up closer to its average historical PE. But I think Home Depot, they have higher margins than Lowe's. They've generally performed better over time. But Lowe's is really, I think, turning around and improving their margins and improving the business. They've got new management in there. And I just think Lowe's is a better undervalued option right now. But I totally understand if people like Home Depot, maybe the answer is to own both. It pays a little bit higher of a dividend, 2.81%. And they've actually grown earnings a little bit slower since 2003. But for Home Depot, if it trades up to that 19 PE, you're getting that 4.7% annual return, which right there shows you kind of why I like Lowe's over Home Depot. Okay, that's just my opinion. If you enjoyed this video, if you like this type of content, do me a favor, like the video. That helps it surface up. That helps YouTube show it to more people. It says, hey, you watched it, you like it. We should show that to more people. Subscribe to the channel so you never miss an update. And if you want more detailed analysis and my email research reports and to follow my portfolio every single update, austin.substack.com, linked in the description below. That is my email newsletter. There is a free version of that newsletter that comes out once a week. Thank you for your support. Appreciate you watching. And let me know if you have any stocks you want me to review down in the comments below.